Overall, on the daily chart, market is forming. Market's in a tight bull channel, but we have a decent bear bar inside of a tight channel. And what's happening? No surprise. We're getting bad follow through buying. We're getting a bad follow through bar today. And that's because the odds are today is probably going to be a disappointment bar. That's because the sell-off is likely to lead to a bear leg in a trading range, and therefore there's probably buyers in the bottom third of the leg. And that's why you're finding buyers in the bottom third right here. So bull bar, I suspect probably sellers above the bar, and we'll probably get a second leg down. If the bears are lucky, we'll find sellers above and we'll get an outside down and we'll test the moving average. But as far as expecting the market to fall 100 points tomorrow, probably not going to happen. But I do think we'll probably test back down here fairly soon. So do I think we're going to get down on the moving average? Yes. I suspect the test of the moving average is probably at this point imminent. But it could take the rest of this week. It could take several days. We may just go sideways here and drag the moving average up. But we're getting so close to the moving average after being away from it for so many bars. Odds are we're going to test it. 5-minute chart. Good buying, 75. So still always in long, but getting late in the day. Bulls buying, they'll probably trail a stop below 75, maybe a couple of points below 75. And I don't think many bulls are going to put a stop all the way down here. Too much risk that there might be sellers up here and we get a deep pullback. So overall, if you're long, while I'm doing the review, we'll keep an eye on what's going on. We'll change it to this just so we can keep an eye on what's going on. But overall, if you're long, I think it's nothing wrong with selling out of longs right here. I probably would. This is so late in the day. The upside is probably limited. But in general, it's just good principle. It's generally a good principle. When you get past bar 72, usually you want to find reasons to exit your trades. Trading late in the day can be really easy to mess it up. So anyways, first bar of the day, we had a decent bear bar and we gapped up. And that gap up it's a large bar. Even though we're gapping up on bar 1, we gapped up, we formed a bear reversal bar on bar 1, and that's a strong enough bar. Odds are we're probably going to get some kind of second leg down. Bar 2, pause, but probably sellers above, and we'll probably test last Friday's close. Went outside down on 3, that's good for the bears, but outside down bar, second leg down in an overall trading range, probably downside is probably limited. You can see bulls still getting buying pressure, but again, probably not going a lot higher. It's always possible we get a large buy climax here. But I suspect the upside's limited. Plus, what are you willing to risk for, the final 10 minutes of the session? A lot of volatility at the end of the day. So usually better just to be flat and waiting. And then 4 or 5 outside up. Good for the bulls. Increases the odds that outside up's good for the bulls. Increases the odds that we may get a second leg up, which the bulls got follow through on. Excuse me, that's bar 4. Bulls got follow through on 5. Strong enough breakout. Good for the bulls, but look where you are. Here's the middle of this trading range and the midpoint. We could easily test all the way down to the lows or the bottom third of this rally before we find buyers. And then 6, bear bar. Not that great of a sell, but overall trading range, probably buyers in the bottom third. And we may test these breakout points over here. Plus on the open, usually you get a lot of trading range price action. 7, bear bar, breaking out below 6, good for the bears. But consecutive bull bars, 4 and 5, probably going to get a second leg up. So really, probably more traders buying down here than selling. But enough of a reversal on 6 follow through 7. There's probably sellers in the upper third of the sell-off. And then we have a bull bar on 8, good for the bulls, but there might be more sellers above 8. 8's a big enough bar that we still may get some kind of, although 8's a big enough bar, we still may get some kind of second leg up. And therefore, I still suspect while there's sellers above 8, there's probably buyers on a pullback after bar 8, and we'll probably get a second leg. Bear bar 9, but probably buyers below 10. We have a second leg up. Now we have 2 legs up testing the close of bar 5. That increases the risk there's sellers up here. And then 11, we have a bear bar, but a tail below the bar. Not a great sell, probably buyers below and sideways. And then 12, we have consecutive bear bars. that increases the odds that we'll get a second leg down. And then we broke below the 10 low pretty strongly on 13. 13, enough of a surprise, probably going to get a second leg down, but a fairly big bar increases the risk. It increases the risk that the downside is probably going to be limited. And then we got a reversal on 14. That's good for the bears, good for the bulls, but enough of a surprise. 13, whatever reversal up we get is probably going to be minor. And by the way, 5-minute chart, you can see. I'll just change it to a day only so we can talk about it real quick. And we have 4 or 5 consecutive bull bars closing on their highs. Good for the bulls, but I suspect buyers in the bottom third and will probably get a second leg. I suspect the downside risk is probably limited, but too late in the day to be trading this bull bar. So probably going to get a second leg up here. Then we got follow through on 15. That's good for the bulls. Probably buyers below and at least a bounce. Bear bar 16, but a low one short. Probably limited upside. So really not a great location for the bears to be selling. I suspect probably buyers below 16, and we'll probably at least get some kind of a bounce. And then 17, bull bar, second leg up after 14 and 15. That's good for the bulls. We're probably sellers above the 17 high. And then bar 18, we formed a small inside bar, not a great buy, right at the moving average. And then 19 started to reverse down. This bear breakout 13 is still likely to get some kind of second leg. And therefore, I suspect we're going to get some kind of second leg down over the next several bars. 19 and 20 consecutive bear bars, good for the bears. Probably going to get another leg down, and we'll probably fall below 14. But if we do, probably buyers not far below 14. Bear bar 21, the tail above the bar after consecutive bear bars, probably sellers above and a second leg down. What's the bears got on 22? 22, a bear bar, part of the micro channel. Probably buyers below scaling and lower, but we may go a little bit lower. Then we have a doji 23, not a great buy. There might be sellers above. And then 24, an outside down. Now we have 3 pushes down. 1, 2, 3. And it's nested with inside of a larger wedge with bar 4, 14, and 24. And then 25, we formed a decent bull reversal bar closing on its high. Good for the bulls. Increases the odds that we're going to get at least a couple of legs up. So always in bulls, I'd get out below 25 to wedge bottom and a possible low of the day. Follow through 26, good for the bulls, probably buyers below. 27, pullback, but a low one short. Not a great sell. I suspect buyers below. And then 28, we have a doji, not a great buy. There might be sellers above and we pull back. But even if we do, I expect buyers below the 28 low. 29, outside up. For 29, we found buyers below the 28 low. And then we formed a reversal up on 29. But it's a bull bar closing on its high at the moving average. Really not a good sell. And then 30, we triggered the buy above 29, reversed down 30. Not a great sell. It's a low too short, but a low too short after a decent reversal bar 25. It's possible that this low too is just part of a bull flag. That will lead to trend resumption and get a reversal up. 31, not a great entry bar for the low two, below 30. And therefore, we might find buyers below. Then 31, reversed up, bull bar, good for the bulls. Probably going to go at least a little bit higher. 33, we have a bull reversal bar and follow through, good for the bulls. So it looks like we're going to go a little bit higher. And at this point, I suspect we'll probably try and test up to near the 14 high and possibly the 19 high over the next several bars. Follow through, 34, good for the bears, good for the bulls, 3 consecutive bull bars, probably buyers below. And then we tried to break to the upside, but instead the market found sellers, probably buyers below the 34, below the 35 low and below 34, but 2 legs up. We could easily fall below 25 before the bulls come in. And then we broke to the downside below. And then we broke to the downside below bar 25 on 36. 36, strong enough bear bar. Even though we may go a little bit lower, it's probably more likely to fail breakout below this wedge here. And therefore, I suspect buyers below 36, 37, a bull bar. But really, even though it's not a great buy, it's a bad sell above the 37 high. And that makes me think buyers below and at least second leg up. 39, bear bar, but probably buyers below. 40, bull bar, probably going to go at least a little bit higher. And therefore, not a great buy. Really not a great buy for excuse me, not a great sell for the bulls. I think bears probably get out above 40. And then we got a surprise 41, good for the bulls. Looks like we're going to go higher. And then we started forming the bad follow through 42, 43, 44. This bad follow through is a sign that we have a spike in small channel. And then we may form a trading range up here. And that's basically what happened. We started alternating bars. The odds are we're going to go above the 38, the 35 high, which is the most recent lower high. But part of the problem that the bulls have is the risk. If you're a bull, where are you going to put a stop? You put it below 39? Probably not. There's probably more buyers. What about below 37? Same thing. Buying here, it's really better if you can buy more below the 37 low. And therefore, the risk is a little bit big for the bulls. And that may reduce the chances we go a lot higher without first pulling back. 49 bear bar, but probably limited downside and limited upside. And then we started forming consecutive bear bars. We got follow through after 49. That increased the risk of a second leg down. Bull bar 51, but probably sellers above. And then 52, not a great sell below. So it looks like we're in breakout mode. And then obviously the bears got the bear breakout on 55. Strong enough surprise. Looks like we're going to get a second leg down, which the bears got with 56, 57, 58. But at this point, now you're at the bottom of the overall range. And so far, every new low has had buyers today. And that increases the risk that 37 is going to be no different. 37 is probably going to find buyers as well. But as far as doing anything here, I think the odds are there's probably going to be more traders buying in this general location rather than selling. And then 59, bear bar, but lack of momentum increased the risk of profit taking by the bears and bulls buying. Outside up 60, good for the bulls. Probably going to get at least a small second leg up. We may have to get a second leg down after the selling, but I think 60 is a warning that we're probably not going a lot lower. And then the bears, they tried to get a bear breakout on 62 below 60, and it found buyers. Not a great buy, 63. It's a relatively small bar, and that increases the risk that we fall below 63. But if we do, I expect buyers below 63 and below 60. 64, outside down. Not a great sell, but probably buyers below 65. Bad entry bar for the bears selling below 63. Bears selling below 64. 2 legs down. I suspect probably more traders buying down here rather than selling. And then you can see, obviously, we got the doji on 66. That's lack of energy by the bears. And then the market reversed strongly to the upside. And that increases the risk. That increased the risk we're going to get a second leg up. Enough of a surprise, probably buyers on a pullback, but a large enough bar. I don't think many traders are really excited to risk 44 points. And that's why this bar started to pull back later as the bar formed. As far as buying the close, I would not. I think it's probably more sellers above the bar. And therefore, traders probably want to see what the pullback looks like. And then obviously we started to pull back, and bears, you'll have some bears selling, but a second leg up is likely. Those bears get out above 72. And bulls started buying, and that's what led to the reversal up right here. And basically, this is where we are. So we're probably going to try and close. Look, we're getting back here. So the top of the channel, spike, pullback channel. This is the start of the channel. For stop orders, you can buy above 4, not great. And then you can sell below 6, betting on an early high of the day. But after bar 5, now I don't know how many traders are going to be eager to do that. Bulls trying to get up here. It's back to stop orders. Bears can sell below 6, or they can sell below 12. Bulls can buy above 8, but I don't think it's ideal. If they do, they get out below 12. What about selling below 13? You can, but you have to be prepared for a deep pullback. And then bulls, if they buy above 14, they definitely get out. I think as 19 starts to reverse down, or they get out below 20. 20 is a little bit late, though. The odds are you're going to get a second leg down after bar 13. Bears, if they're short, they definitely get out above 25. Bulls can buy. They can get out below 36, but I think they have to buy above 32. Bulls, if they buy 32, they probably sell below the 35 low. And then bears can sell below 35. And if they do, they get out above 37. As far as bulls buying 37, I think it's reasonable. I don't think they have to get out below 39. Other bulls can buy above 40. And then if they're long, they probably get out below any of these bars up here. I think the risk is getting too big, and it's a little bit challenging to stay long. Bulls, if they're still long on 55, they get out. Bears can sell. And then the bears get out above 60. The bears get out above 60. Bulls can buy. But if they do, it's probably better if they can buy more below 60 as well. And then obviously trading range, weak signal bar, and the market broke to the upside on 67. And then if you're really aggressive, the bulls, I think they can buy again above 72. I would not look to sell below 69 because 67, odds are you're going to get a second leg up. Limit orders, I thought probably buyers below 2. I thought sellers above 8, but better to sell above 9 because 9 is an implied pullback after 8. I thought sellers above 15, and then probably sellers above 21, but never triggered. And I thought buyers below 22, buyers below 23 for at least a second leg up. I thought buyers below 26. And then up here, I thought maybe sellers above that were so close to the target that I thought we may have to get there first. And then down here, I thought buyers at the 36 low. So the only thing I'm doing down here is looking to buy. I'm not interested in selling at this point, and I thought buyers below 65. And then after the bounce, I thought buyers on a pullback, but obviously, certainly not easy. As far as buy the close, sell the close, overall, I think that not really any is channel, and it's a trending trading range, so it's really not great to buy the close or sell the close. Bear breakout 13, probably better to buy the close than sell the close. And really looking, maybe sell 57, but it's in the bottom of the range. So if I say 57, sell the close, I'm kind of being contradicting to what I said about at 57. I said 57's more of a buy zone. And then, maybe buy the close 74 if you're really aggressive, but that's probably it. Everything else was more enter on a pullback. Wait for the breakout 13 and then wait for a pullback and sell above bars, betting on a second leg down. Same thing here. 41, don't buy the close, buy a pullback. Here, maybe you sell the first reversal up, but I think dangerous to sell above 58. As far as tomorrow, I think that tomorrow is a bad buy signal bar for the bulls. And I think tomorrow's a warning that whatever second leg we get is probably going to find buyers, especially at the moving average. Downside risk is still limited, although the odds are we're probably going to test the moving average soon. The question, how long did it take before you were comfortable selling above big bull bars, even though second leg for the bulls were likely? Well, if you have a bar number in mind, that would be really helpful. So since you wrote it in Discord, I'm assuming you're listening, give me a bar number. Okay, great, bar 17. So how long did it take for you to be comfortable with selling above a bar like bar 17? It took me a while, but what's interesting is if you think about it, if you really define a good stop order means it's a bad limit order. So what's good for one side is bad for the other. If one side is 60%, that means the other side's 40%. And if both sides are 50-50, it's bad for both sides. So when I think about a good limit order trade, what I think about is a bad stop order. And if I ever look at the market and I say, wow, if I say there's no way I'm going to buy on a stop above 17, that's a low probability buy. Well, what does that tell me? That tells me that traders selling the close or selling above 17 are probably going to make money. And therefore, if traders are selling above bar 7, if traders are not interested in buying above 17, then what are bears going to do? They're going to sell above 17. And if you're not interested in buying above 17, think about it from the perspective of being long. If you're long, you don't want to be long, so you're going to sell. And so what I started thinking about is there's really no difference. Think about the logic of what I talked about even below 25. I made the comment, there's probably buyers below the 25 low. And because of that, I'm just not interested in buying below. I'm not going to be interested in selling below 25. And if I'm not interested in selling below 25, realistically, if I don't want to sell below 25, then what can I do below bar 25? I can buy it. Obviously, it's a little more difficult to buy below a bar such as the 25 low, and it's easier to wait for a stop order. But that's the same logic. For me, there's no different. If you really have to see the market from the standpoint of risk is from the market price to your stop, not your entry price. And therefore, if you think about it from the perspective of the bulls, a good example is that 44-point bar we had later in the day. 67 is a fairly large bull bar closing on its high. And if we think about it from that perspective, 67 is 44.5 points tall, I believe. And if you think about it, do you want to buy? Do you want to buy the high tick of bar 40 bar 67? Probably not. A lot of traders don't want to risk 44 points on the trade, and therefore, what happened intra-bar? You had traders selling. We can see it on a 1-minute chart. You have this bar, the risk is so big, and this bar alone is really big that a lot of traders just aren't interested in buying. They see the risk is too big. Even if they bought, someone fortunate enough bought on a stop above this bar. And if they did, they made a lot of money relatively quickly. So what are they going to do? As this bar is racing up, they're going to say, wow, that was a little bit faster than what I thought. I'm going to start reducing my position. And at some point, there's an imbalance. There's too many bulls looking to sell and too many bears shorting that the market has to pull back in order to find enough bulls willing to buy. But it took a long time, to think about it logically like that. And someone made a comment. They said, I always find it difficult in a trading range to do the opposite, meaning buy low, sell high, and scalp. I did have one trade where I did exactly that and it worked well, but it took a lot of courage. It feels like the trades require a lot of courage often work better than the ones that seem easy. Is that normal? Yeah, if you think about it, what you're saying, you describe it as courage. Really, I think what you're looking at is, what I hear you saying is the trades that require a lot of courage are typically work better than the ones that seem easy. Well, the ones that seem easy, think about what you're telling yourself. What you're saying to yourself is that you're not seeing the other side of the trade. If I see a guaranteed way to make money, you know that the odds are I'm probably wrong in my thinking. And if I'm wrong in my thinking, there's something I'm missing. So that's the way I look at it. But overall, it's natural. It's backwards behavior. You see a big bull bar, normally you look to buy. You see a big bear bar, you want to sell it. I think it's natural for traders to, one moment. I thank everyone for dealing with the extra sounds right now. Obviously, there may or may not be a child in my hands as I'm talking right at the end of the day. So I appreciate y'all's patience. But, I want to try to answer these as best as I can. But overall, as far as your question goes, I think it takes a long time to start thinking about the market from a backwards perspective. It's very easy to look at the market and be fearful of missing something. And I remember all the time hearing Al, and it's still to this day. You listen to Al, and he's just so calm. He doesn't. You think to yourself, it's like, Al, you're missing this entire move. Like, how do you not care? Doesn't that just eat you alive? And if you ask Al would say, not really, because he knows there's going to be another trade later on. And I've just learned that when you have a bar that just basically forces you, a situation like, for example, like this. You have a bar like this, and you see the market's going sideways, and you're thinking, yeah, it's a trading range breakout mode. And all of a sudden you say, well, wait a minute. Now we're always in short, and it's forcing me to sell this really big bar. If it's forcing you to sell this really big bar all of a sudden, you have to ask, is that really a strong breakout, or is it a sell vacuum? And the way I think about it is, if I'm scared, you have to think about it from the perspective of, okay, we have a breakout. Well, why not wait for the follow through? Well, I don't want to wait for follow through because I'm fearful that I may miss the move. If I'm fearful I'm going to miss the move, what does that tell me? That tells me that I'm naturally not thinking about the market correctly. Most traders, I think traders naturally, they don't think about how much energy it takes to create a trend. Trends are relentless. And I always kind of think of like a freight train. You can think about a train. If a train, let's say a train has, 100 cars behind it, how much energy does it take to get that actually going 20 or 30 miles an hour? It probably takes a lot of energy. And it also takes a lot of energy to stop it. I know I could do better with answering that question. But the point, I think the point behind it is, how do you learn to see things as the opposite? I think you just learn that most breakouts fail. And most breakouts fail, but most breakouts also successfully get a second leg. So what does that really mean? That means if you do the opposite of the breakout bar, usually you can make money. You buy the close of bar 13, And what happens? The market bounces. She bought, you could scalp out. A trader could sell the close at 13, scale in, and they can make money. The market goes lower. A trader could buy, scale in, and they could still get back out at the close of 13. So overall, I think that the biggest thing I would tell you is it's natural behavior. Once you start to realize that most breakouts pull back, you start to realize that a lot of times you can fade breakouts. And as long as you can recognize really strong breakouts that are likely to lead to a trend, you're probably going to do okay. I don't know if that really, I hope that answers your question overall. But then you get used to it. I think that's really that's one of the biggest things I would say with that. I'll give a few more minutes for questions, but I'm not seeing any more questions come in. Yes, Andrew said what you said about how to think is helpful. Yeah, I think I don't think this, I know this. Your frame of thinking regarding the market's going to always evolve. And that's why you can't watch the video course once and gather everything. You got to watch it once. And the more you watch it, the more you're going to expand your trading IQ. It's kind of like, as many of you know, I talk a lot about systems, and you can build trading systems. And a trading system is simply a trading plan. It's not an actual programmed trading algorithm. I don't know how to do that. So if you're asking me how to do that, you're in the wrong group. But the point is, I've talked to a lot of people about, they say, Brad, how do you build a trading plan? Or I need to build a trading system. How do I do that? And it really comes down to how well they understand price action. If you go, if you're day one and you just bought Al's video course and you've watched 5 minutes of it, and you say, okay, I'm going to build a trading system out of Al's course. How do I do that? Or a trading plan? You're not going to know the right questions to ask. Even when you've seen the video course once, you may understand price action significantly better. You're not going to understand everything that you need to know. And therefore, the more you think about it, the more your thinking is going to evolve. A lot of people get frustrated because they say Al's course is unorganized. And if you think about it, it actually is organized. One of the biggest complaints I hear is they say, well, Al talks about a wedge in the first video, but he doesn't explain what a wedge is until the 5th video. There's no way around that, because the reality is you have to understand a little bit about everything in order to understand the topic. And that's why when you're watching Al's video course, the first goal is just watch the entire course and get the frame of thinking. Then you go through the course again and take notes. And then you review your notes and start thinking, okay, what do I understand? What do I not understand? And then as far as thinking through how to think and how to design things, the first system or trading idea I would build is the ability to understand context, trend, or a trading range. So take Al's video course and think about, if the market's in a trend, how do I define trending behavior? And if the market's in a trading range, how do I define trading range behavior? But overall, you take it piece by piece. So I hope that helps. As far as tomorrow, I suspect there's probably going to be buyers. I suspect we're going to the moving average. There's probably sellers above today's high, but it's possible we have to test the upper third of last Friday's high before sellers come in. But I suspect we're going to get down to the moving average fairly soon. Okay, thanks everyone, and I appreciate everybody listening, and I will talk to everybody later on. Have a good afternoon.
Thank you.